Have you ever wondered why squeeze momentum is one of those indicators that just refuses to disappear? Traders watch the histogram colors, wait for the squeeze, and hope to catch the next explosion. But there are two pieces of information sitting inside this indicator that most people barely use. Today, we are going to turn both of them into simple, testable methods on SOXL's 1-hour chart.
The TradingView version most traders know was published by Lazy Bear back in 2014 as a derivative of John Carter's TTM squeeze. The idea is simple. Markets alternate between compression and expansion. Find the compression, measure the momentum, then watch for the release. That combination of volatility and momentum is why this indicator has stayed relevant for so long. Under the hood, the squeeze compares Bollinger Bands with Keltner channels. In our version, the Bollinger Bands use a 20-bar average and a 2 standard deviation multiplier. The Keltner channel uses 30 bars and a 1.5 multiplier with true range. When the Bollinger Bands contract inside the Keltner channel, volatility is compressed. When they expand back outside, the squeeze is released. But the histogram is the part I care about today. It is not just a random momentum bar. The script compares price with a 30-bar equilibrium built from the recent high-low midpoint and a 30-bar moving average, then runs that difference through linear regression. Above zero means the regression momentum is on the positive side of that equilibrium. Below zero means it is on the negative side. The bar color tells you whether that momentum is improving or deteriorating. The classic use is to wait for the squeeze to release, then trade in the direction of the momentum histogram. Lazy Bear's original notes describe the same basic idea. Wait for the release, use momentum for direction, and watch the histogram change for the exit. That is a perfectly valid way to read the indicator, but it is not the only way. Forget the squeeze dots for a moment. Look directly at the zero line, then look at the shape of the histogram itself. Those two things give us two completely different methods, a momentum regime switch and price versus momentum divergence. Method 1 is almost embarrassingly simple. Keep the Keltner length at 30. When the squeeze momentum value crosses from below zero to above zero, that is the buy signal. When it crosses from above zero to below zero, that is the sell or long exit signal. We do not care whether one individual bar just changed from red to green. We are waiting for the entire momentum calculation to move from one side of equilibrium to the other. Here is a real example from the SOXL 1-hour data. In May 2025, the histogram pushed through zero and the long entry was taken on the next bar. The position stayed open until the opposite zero cross. On this particular sequence, the move produced roughly 45% after the small transaction cost assumption used in our test. The point is not that every cross does this. The point is that the zero line can behave like a clean trend regime boundary. And here is why I do not want to sell you a fantasy. Just a few weeks earlier, SOXL produced a zero cross long that failed badly and reversed almost immediately. That trade lost roughly 25%. SOXL is a leveraged ETF, and a lagging momentum cross can get punished when the market snaps back. A useful signal is not the same thing as a perfect signal, so I tested the rule exactly as described, without optimizing the exit. The data contains 23,000 1-hour SOXL bars from January 2022 through August 2026. The test is long only. Buy the next bar after an upward zero cross. Close the next bar after a downward zero cross. No stop loss, no take profit, and 0.05% cost on each side. It produced 351 trades, a 43.9% win rate, and a profit factor of about 1.20. Using a fixed $1,000 position for every trade, the net gain was about $2,028. Useful? Yes. Holy grail? Definitely not. Method 2 ignores the zero cross completely. Instead, we compare price swings with the squeeze momentum histogram. A bullish divergence happens when price makes a lower low, but the histogram makes a higher low while still below zero. A bearish divergence is the mirror image. Price makes a higher high, while the histogram makes a lower high above zero. Look at this SOXL example from October 2023. Price pushed to a marginally lower low, but the histogram refused to make a lower low with it. The second momentum trough was less negative. That does not guarantee a reversal, but it tells us something important. Price made new downside progress without a matching expansion in downside momentum. The two series are disagreeing. Now flip the logic. In October 2022, SOXL pushed to higher price highs while the positive squeeze momentum peaks became progressively weaker. Price was still climbing, but the internal momentum measurement was losing strength. Shortly afterward, price rolled over hard. Again, divergence is not prophecy. It is evidence that the newest price extreme has weaker momentum support than the previous one. The biggest problem with divergence is that traders can draw it almost anywhere after the fact. So for this video, I made the rule mechanical. We use confirmed price pivots with 5 bars on the left and 5 bars on the right. For bullish divergence, the second price pivot must be lower, while the histogram value at that pivot is higher, and both oscillator values must be below 0. Bearish divergence requires the opposite. The signal only exists after those 5 right side bars have confirmed the pivot. Using bullish divergence as the long entry and bearish divergence as the long exit, with the same next bar execution and transaction cost assumptions, the test produced only 56 completed trades. The win rate increased to 57.1%, the profit factor was about 1.16, and the fixed $1,000 model gained about $593. So divergence was much more selective, but it was not automatically more profitable. This is where the indicator gets interesting. I do not recommend blindly forcing the two rules into one system. In fact, a simple mechanical combination performed worse in my test. Instead, think of them as two different lenses. Divergence can warn that the current move is losing momentum before the trend has actually changed. The zero-line cross can tell you that the regression momentum has finally moved to the other side of equilibrium. In this October 2023 example, bullish divergence appeared first and the upward zero cross followed almost immediately. That is the kind of sequence worth paying attention to. So here is the practical framework. Use method 1 when you want a clean, objective trend regime trigger. Below 0 to above 0 for long, above 0 to below 0 for exit. Use method 2 when you want an earlier warning that a price swing may be running out of momentum. If they agree, great. If they do not invent a trade just to make the chart fit your story. Do not buy every green histogram bar. Do not draw divergence using unconfirmed pivots and pretend you saw it in real time. Do not assume a zero cross eliminates risk. And do not optimize 20 different settings until the pass looks perfect. This video uses the 30-bar Keltner setting you asked for and keeps the rules deliberately simple, so we are testing the idea, not curve fitting the history. So the next time you load squeeze momentum, look beyond the usual squeeze release setup. Method 1. Treat the zero line as a momentum regime boundary. Method 2. Compare price extremes with the histogram for confirmed divergence. Neither is magic, but both reveal information that is easy to miss when you only stare at the bar colors. This is Pine logic. Build it, test it, trade the logic.